Hello friends, in this video I'm going to talk about group term life insurance coverage provided by the employer. I will talk about the tax implications of the coverage on employees W-2, and also I will go over some examples to explain how to calculate the taxable amount. So let's get started. Group term life insurance, I will refer to it as GTL. What is group term life insurance? So the group term life insurance is exactly as it sounds. It's a type of insurance that is offered to the group. Group term life insurance is actually a fringe benefit which is offered in addition to employees' regular wages by the employer. In order for the employer to offer the group term life insurance, following requirements must be met. The coverage provides general death benefit that is not included in the income. Number 2, the employer provides the GTL to at least 10 full-time employees at some time during the year. There could be some exceptions to this. Number 3, the employer is not biased towards certain employees, meaning that he should not only be giving the group term life insurance benefit to, for example, the highly compensated employees. So there should be no bias involved. The policy should be neutral for all the employees. Number 4, the employer carries the group term life insurance policy directly or indirectly. Let's talk about the taxes. Is the group term life insurance taxable to the employee? The answer to this is partly yes, it is taxable, and partly non-taxable. So the first $50,000 contributed by the employer towards the policy is actually not taxable to the employee. Any excess amount over $50,000 is taxable to the employee, and it is taxable for Social Security, Medicare, but not for the federal income tax and FUTA. Actually, the federal income tax can be optional at the option of the employer. Now, if the employee contributes towards the group term life insurance, that contribution amount, the cost, should be deducted from the gross income, and it should not be taxable. Why? Because the employee is making the contribution from his after-tax income. So if in order to prevent the double taxation, it is not taxable. I mean, if you will tax whatever the employee is contributing, again, it will be like taxing twice. So that amount is not taxable. Another thing to remember is that if the employer has the coverage for employees' dependents and the employer pays up to $2,000 for the coverage for employees' dependents, that amount of $2,000 is not taxable to the employee. But if more than $2,000 is contributed by the employer, then the entire amounts become taxable to the employee. The dependent group term coverage is taxable for Social Security, Medicare, federal income tax, but not for FUTA. Now let's have a look at what goes on the W-2 and on which box it goes to. When we talk about the taxable part of the group term life insurance policy, we are talking actually about the cost of contribution over 50,000 by the employer. The cost of contribution over 50,000 by the employer is reported as a taxable income on employee's W-2. And it goes on box 1, on which you have the total income of the year. It goes in box 2 for federal income tax if the employer contributed for dependent group term life insurance and the amount contributed was over $2,000. It goes on box 3 for the wages taxed for Social Security, and it goes on box 5, which has the wages taxed for Medicare. And it also goes on box 12 with the code C. Now here I have written a word cascade, which is like a mnemonic, because the group term life insurance is related to the death benefits. That's why in order to remember C, you can remember the word cascade. That's how I have related it. How much to include in employee's W-2 as taxable income? As I told you on my previous slide, that it is the cost for the whole year that is taxable to the employee, and that cost goes on the W-2. In order to calculate the cost, you need few things. First of all, you have to know what is the total amount of the contribution, total amount of the policy that the employer is providing. And secondly, you want to know the age of the employee. You also need to refer to the IRS publication 15B, and I believe it's section number 13. And under that section, you will find the table that says table 2.2, cost for, that's the cost per $1,000 of protection for 1 month. Now the words are very important. This cost that is on the right hand side, and there is age on the left hand side. This cost is for 1 month. You must include in your employee's wages the cost of group term life insurance beyond 50,000 worth of coverage, reduced by the amount the employee paid towards the insurance. This is, I have put that sentence in bold because this is very important. You must include in your employee's wages the cost of group term life insurance beyond 50,000 worth of coverage, reduced by the amount the employee paid towards the insurance. On this slide, I have just a table just to make it big and bold so that you can see for each age the cost. And now we are going to do a few examples. I will show you how to calculate that cost, and the cost that we are going to, that is going to be taxable to the employee, and it goes on the W-2. So we will do some examples now. So let's say that we're going to actually do 3 examples. Let's assume that the employer provides $150,000 in group term life insurance to all his employees. And we are picking 3 employees: Mac, who is 30 years old, and then we have Sarah, who is 50 years old. And then we are going to do another example in which both the employer and the employee contributes towards the group term life insurance coverage. Now, what we are going to do, we are going to calculate the monthly cost. We are going to find out how much of the total group term life insurance is taxable. We are going to calculate what is the yearly cost of coverage per employee and what goes on W-2 and where. So let's look at first Mac. Mac, who is 30 years old, and he has a total coverage of $150,000. If you remember, I have told you in the previous slide that the first $50,000 is non-taxable. First 50,000, the total amount could be any, it could be $200,000, it could be $500,000, but the first $50,000 is non-taxable. The cost that is related to the first 50,000 is not taxed to the employee. Now in this case, the total coverage is 150,000. So step 1 would be to find out the taxable amount of the coverage, which is 150,000 minus 50,000. So the taxable amount of the coverage is 100,000. Step 2 would be to divide that 100,000 of the taxable coverage by 1,000. Why are we dividing it by 1,000? Because if we refer to our table, the table says it's cost per 1,000 of protection for 1 month. That's why we are dividing our taxable coverage by 1,000. This is an important step. Divide the taxable coverage by 1,000 and you will get a number. In this case, the number is 100. Now go back into the table and look for the age 30, because Mac is 30 years old, so we are going to look for age 30 and we're going to find the cost. So the age 30 to 34, it's the third row on the table, and the amount across is 0.08. So that is the cost we are going to use. So we found the cost that it is 0.08. We will multiply the 100 from step 2 by 0.08 and we get $8. Now this $8 is the monthly cost because the table is giving us the monthly coverage. Step 5 is because the taxable amount is going to go on the W-2 and the W-2 has the income for the whole year, so we need to find the cost for the whole year. That's why we are going to multiply the monthly cost of $8 by 12 to get the cost for the whole year, and in this case it's $96. So the $96 is the taxable income that goes on Mac's W-2. It will go on box 1, 3, 5, box 12, C. So that's how you calculate. Now let's look at another example. It's same kind of example with a different age. We have Sarah, who is 50 years old, same coverage, $150,000. So step 1 is same, step 2 is same. Divide the $100,000 taxable coverage by 1,000, you again get 100. Step 3, you go back into the table and look under age 50. So let's go back into the table and look under age 50, which is almost in the center, and you will see that the cost is 0.23. So we get that cost and we multiply our 100 by 0.23. We get the monthly cost of $23. Step 5 is to convert the monthly cost to the cost for the whole year. We multiply the monthly cost by 12 and we get $276. So $276 is taxable income to Sarah, and it goes again on box 1, 3, 5, and 12C on Sarah's W-2. Let's look at another example. It's kind of the same example, but here in this situation, Sarah, who is 50 years old, same coverage, $150,000. But in this example, Sarah is also contributing towards the coverage. So Sarah is contributing $100 per year towards the cost of coverage. This is the information given to us. Same steps. You will calculate the taxable coverage. You will divide it by 1,000. Go back into the table, look for the age, same 0.23, multiply the 100 from step 2 by 23 and you get the cost for the month. You multiply the cost for the month by 12, you get 276 in step 5. Now, out of the 276, $100 are contributed by Sarah. So if Sarah is contributing $100 out of 276, then only 176 will be added as taxable on Sarah's W-2, and $100 will be deducted from his gross income. That's all in this video. Hope it was helpful. Stay tuned to my channel for more informative videos. Wishing you all a very happy, healthy new year. Goodbye for now.